Rocket Companies, or Rocket Stock, RKT Stock, IPO'd in August of 2020. The company is a pioneer in the home mortgage origination market, the largest home lender, #1 in the United States, and quickly gaining market share. The consistent share gains reflect what I suspect to be an unrivaled value proposition. They clearly have some special sauce with Rocket. Meanwhile, the Rocket is rapidly embracing new target markets, expanding their addressable market share, their addressable market, like Canadian mortgages or title insurance or auto loans, for example. And the auto loans is slightly different, where it's a fee for referral business model, but we'll get into all the nitty-gritty of the business model shortly. I'm very impressed with what the founder, Dan Gilbert, and his team at Rocket have built, but ultimately it's a super tricky business model. Now, and it's also a tricky org structure. You know, compared to many of the companies I've covered in the past, on a scale of 1 to 10, I'd probably put this somewhere between like 7 and 9 in terms of complexity. So, you know, you're definitely going to need to have your thinking cap on. That said, I don't oftentimes cover companies that I think are like, wow, this really does have something special. You truly do have science capturing market share. And I also think there could be potential upside of a couple 100% from here. I think it's going to be a bumpy ride for existing shareholders. And this video goes out to Danny, Dave, and Ram, along with all my Unrivaled Investing Journey subscribers. About that, a quick 10-second plug, if you will. My name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find you exceptional companies and unrivaled investments. If you enjoy looking and learning about potential multi-baggers, the types of companies that go up hundreds or thousands of percent, make sure to subscribe. If you're already a subscriber, I appreciate that thumbs up. And if you want to follow my personal journey, see which of the potential multi-baggers I'm actually buying for my own portfolio, along with, you know, each month calling out, hey, here's a potential multi-bagger, go to unrivaledinvesting.com, click on Journey. Let's dig into Rocket so you can learn a little bit about this business model, and keep in mind it's super complex and you're going to need your thinking cap. So what is Rocket, or RKT Stock? So it's the #1 largest home lender in the United States, and it is not an overnight success. This is something that's been building over years, where you can see 11 years as the #1 primary mortgage origination. This is all by J.D. Powers. 7 years the primary #1 for primary mortgage servicing, meaning the people with their mortgage, they're pleased with how it, you know, it's servicing them. So if there's a delinquent period, you know, everything goes smoothly in terms of the funds are being collected. So And look, you can see the cumulative loan origination, over $1 trillion cumulative loan origination, loan volume since business inception from a few decades ago. So this is a building giant, a fintech giant over time with the platform that they're building. And they're setting their eyes on expanding into other markets beyond the home loan origination market. You know, you start off with home loan origination, and in the US, that's a $2 to $3 trillion market. So a huge market that they're already in, but they're rapidly gaining share. They're currently around 10%, which is incredible. #1 player. Now they're starting to move into other things like associated services, like title insurance, or getting a valuation done when you're getting your home purchase, or settlement. And then you have loan servicing, which we'll talk about in a little bit. Personal loans, a whole nother market for them to be getting into. Auto loans, and potentially going into mortgage loans, mortgage loans in Canada. So they're just a pioneer, quickly trying to take on new markets and taking their lead and rolling with it and taking more and more share over time, which is what I love to see with companies. So how are they taking share? I mean, look at this. They've gone from 1% market share, $25 billion in loan origination, to $145 billion in 2019. That number only dramatically increased in 2020 to nearly 10%, a little over 9% in 2020. I mean, it is incredible how they've consistently taken market share each year, nearly each year. You know, here you have this one dip in 2015, but by and large, they've been growing significantly. The question is, like, if home loan mortgages, I mean, home mortgages, this is supposed to be a commodity space. So how is this possible for them to be taking share? Like, how is it possible that they're winning? And so let's go into a couple of the angles here. So one is that they are effectively a digital first company, playing a internet viral media marketing campaign, and honestly, they're just doing a better job of it. Their A game with the marketing side is just better than, let's say, the major depository institutions like the major banks that provide home loan, mortgages. I mean, look, if they can make Aquaman look like this, they deserve to win. Like it's just kind of crazy. And they have their names all over, major events like the Super Bowl. Another aspect is partnerships, where they have partnered with these three major brands. And this is the part that's interesting, is management at Rocket recognized, hey, you know what? In order to get these pristine leads of who would be a good person to loan to for getting a home, getting all that information from them, that's a pain. So what if we partner with some of these major companies? They don't necessarily give us all the detailed information, but they can create a profile for us on some of these customers. The customers at Charles Schwab, the customers at Intuit, doing your TurboTaxes, American Express, how much money you're spending, who are the premium customers. Can you create some sort of filtered data for us to figure out who are the pristine customers that we should be lending to based on this data? And we can send out feelers preemptively if they're interested in getting a loan. You know what? We can work directly with them to figure out who we should be marketing to. So that's effectively an edge with marketing. You pay these folks to get this deal. Now, one should recognize, it's definitely going to be easier to win customers if the customers themselves don't even know that they're going to get solicited in the first place. The customers don't even have to put in their information. It's effectively being rerouted from these partnerships to Rocket Mortgages, and then they're effectively marketing to these customers. So that is an edge, especially when you think these are pristine institutions, or at least they're major brands, and they're not going to trust any no-name brand to sort of share the Glengarry leads of who their customers are. They need, as management describes, a world-class brand to partner with to share this type of information. And I think that's very fitting for what Rocket's trying to build. And so doing these types of ad campaigns where they're getting their name out, Rocket Mortgage, does create this sort of world-class brand. Oh yeah, American Express will be happy to partner with you. And that's partly what drove 2019 growth. I mean, it's incredible. Where you see green is partner network, red is direct-to-consumer marketing. You can see green really took off from $19 billion in origination to $53 billion in origination in 2019, more than doubling. So you can see their initiatives. This was probably Intuit over time. So their initiatives to find and sort of stake more partnerships strikes me as very clever and a good pathway to growth longer term. And getting the grade A leads of who is a great candidate to provide a home mortgage to, and who's going to be who will make sure they pay down their loan, who will not be delinquent. And another aspect to this is how are you able to put up these types of numbers, which is incredible. And this is once again part of playing their A game, is they see who's checking in on their going into their Rocket Mortgage site to see, oh, what's my current financing rate? What am I currently paying? And they preemptively say, you know what, if someone's consistently checking in, they're probably going to want to refinance. So you know what, they capture 76% of the refinancing retention. So that's just incredible. 76% refinancing retention levels versus an industry standard of 22%. So the way I think about this, it's not 100% sure, but is that if they provided the initial loan, 76% of the time they get the refinancing as well, which is literally 3.5 times better than how the rest of the industry compares. So this is what I'd argue is basic blocking and tackling that results in huge differences, and partly because it's a tech-first company. So they see, oh, you're going into the website to check out, what your loan is relative to the market. We know you're interested in refinancing. Let's reach out to you preemptively to make sure that you effectively go through us once again. And another key aspect of how come they're winning so much is in gaining this share is they talk about their NPS score, or Net Promoter Score, i.e. customers like doing business with them. The people that are getting their home loan, they are generally very happy with this loan. And this is very, very, very happy with the process of getting the loan. And this is very favorable relative to the industry average of 16. So 74 means the vast majority of people would be willing to effectively refer Rocket Mortgage to a peer in terms of going through the process. Whereas the vast majority, it's like, man, this, my brother described himself as being a piñata in the process, where it just feels brutal and you're constantly getting kicked or punched. And that makes sense when the industry average is 16 versus here, Rocket Mortgage, it's at 74. Vast majority of people say, hey, favorable experience. And why is that? And the reason why is it such a low rating with most mortgage brokers, or mortgage originators, is that it's a messy process for the customer that wants to buy a house and get a mortgage. You have to work with the mortgage loan officer, the loan processor, the title company, the application, your income verification. You have to cover all these different things. You have to get your home appraised, insurance. You have to work with the real estate agent. There are all these different things that you're just getting beat up along the way in terms of fees. And oh my gosh, I already gave this paperwork. Whereas here it is, they're trying to make this a seamless process. And the fact is that they bring in a lot of these things in-house to make it go a lot smoother. So that way you don't have to be faxing in the paperwork 3 times to make sure, let's say, the real estate agent is coordinating with the mortgage loan officer to make sure it's all going well. Here it is, if the real estate agent has a relationship with Rocket Mortgage, which is something that Rocket Mortgage is investing in, developing these relationships, then it creates a much more seamless experience. And management and Dan Gilbert has talked about in the past mousetrapping each step of the way, where mousetrapping is like, how do we build a better mousetrap for each of these incremental steps in the home buying process, such that could we do this all in an automated way? You just put in your information once and everything goes smoother. And the answer is, I think so, because they point to the fact that the average number of days to close is around 30, a little over 30 days, versus the industry standard of 43 days. So that's a huge difference. And that may not seem like a lot at first, but when you understand each of these transactions, there's a counterparty that's looking to sell. And they don't want to have to hold on to that mortgage that they're not living in the house, they're looking to sell out of it. An extra 13 days, that's mortgage interest expense that they have to pay. So this is why you start creating these very favorable dynamics, or maybe it's an extra 13 days of rent that you have to pay before you move into your house. So that's a big delta, and the reason why they're able to arguably get a high NPS scores. People are very pleased with how quickly they're able to get these deals done, and time is of the essence with getting your mortgage, your home mortgage. Now, not only are they able to do it better and faster than the industry, but they're also writing better loans. And that's an amazing part of this, where their delinquency for loans that are, let's say, loans that haven't paid or 60 days plus delinquent, it's about 1% of their unpaid balance versus an industry standard of over 3%. So this also reinforces the idea that they're just getting better leads. They're using an algorithm to better source how to price people and get the right folks for certain loans. And so this delinquency rate also helps with establishing good counterparties for their mortgage origination business, because this is ultimately, Rocket Mortgage is primarily home origination loans, and so that's their business model. So there's so much to cover here, and there's a lot more detail, but like what I realize is there's a lot of complexity as well with the inherent business model in terms of how do they make money. So let's actually dive into that, because that you're definitely going to need your thinking cap on, because this is just their revenue statement that you're looking at. This is not, I've recently covered a consumer, packaged goods company, and I talked about it with my Unrivaled Investing Journey subs, and it's growing well over 100%. And it's like very straightforward, like one line item for revenue. Whereas here, you look at this and there's like, fix your glasses, because there's 5 different line items, and it's not like one line item's completely immaterial. It's, each of these are sizable pieces, hundreds of millions plus in revenue. So you want to understand what's actually going on. I'd argue interest income is probably the smallest piece that you could probably ignore. But the rest are all sizable, like 950 million, 4.9 billion, 739 million. So and negative 1.6 billion. So like, what the heck is that? See, you're gonna need, if you really want to understand Rocket Mortgages, you're definitely gonna need that thinking cap to be able to dive into each of these pieces. So how do you think about these different components? And let's start off with the biggest component, which is ultimately what they are, which is this gain on sale of loans. That's a key component. We're going to go into that. Then we're going to go into these next two pieces: the servicing fee income and the change in fair value of mortgage servicing rights, or MSRs. These other two components we'll also get into, but let's start with this gain on sale of loans and the way that business model works. So the gain on sale of loans. So they originate a loan. Let's say they originate $145 billion worth of loans in 2019. They don't keep most of that on their balance sheet. The vast majority gets shipped off their balance sheet within days. They partner with either government institutions, think Freddie Mae or Freddie Mac, Fannie Mae, Freddie Mac, or various different third-party buyers that are just interested in owning home mortgages as an asset. So they sell those mortgages, and keep in mind, they have the best ratings in the industry in terms of defaults, in terms of being able to get this paid over time. And so they're selling these loans at a markup. So they originate them and then they sell a markup for about 3-4%. You can see sometimes it's low, like 2.6%. Sometimes it's high, 3.97%. So it's a range of profitability that they get on these mortgages that they sell. So this requires having a very full relationship with all the bankers, potential investors, and government institutions that will be buying these loans. So that's a critical aspect to this business model. Having pristine loans, a better default rate, and capturing that refinancing, that's a good part of this as well. But people would be interested in investing in these loans knowing that there's favorable delinquency rates. So this is understanding this is the key aspect of their business model, which is what's their market share of the total home loans originated in the United States. Their market share has consistently gone up. In 2020, it was closer to 10%. Here it is, 9.2% in the first quarter of 2020. And if they originate 50 billion plus and they get 3% spread, 3%, it's adjusted. This is not exactly, because it ties out with some hedges and some other things. This ties out to the gain on sale of loans, which is the biggest component. So when you're thinking about this, you need to think about how much are they going to originate in the future, which is based on how many home loans are going to be originated in the future, which is really a function of market share of a multi-trillion-dollar U.S. market, somewhere between $2 and $3 trillion per year in home mortgages. So then the next component, this servicing fee income, how is that calculated? The way to think about that is when they sell, so they originate the loan and then they sell it off to someone else, whether or not it's a government institution or investor. The investors, they don't want to have to deal with collections and making sure the funds keep coming in and they're paying the right amount. Investors don't want anything to do with that. So instead, they pay, in this case, Rocket Mortgages, a servicing fee where you take the unpaid balance and you take a percentage of it each month, a very teeny tiny percentage or a fixed fee that gets paid to Rocket Mortgages. So or Rocket companies, and that's how they're getting paid over time. And so as they originate more and more loans, that number should just keep going up at a pretty steady rate because they, for the most part, hold on to those servicing rights. So they get paid sort of an annuity, a recurring revenue stream on that servicing income each year. Very stable business and increasing over time, sort of an escalator business. The next component is that mortgage servicing value, that MSR. Here it is, this MSR, the change in fair value of mortgage servicing rights. What does that mean? Well, part of the tricky, what's tricky about mortgage servicing rights is that what they're saying is if interest rates, and this is where it gets super tricky, is if interest rates, let's say, move up, then you're less likely to refinance. So you're more likely to stick with your loans. And if you're more likely to stick with your loans, then the servicing right which is valued over a multi-year perspective, is likely to continue generating revenue for you. So therefore, your mortgage servicing rate increases if interest rates go up. Now, if interest rates go down, then they'll say, well, wait a second, people are more likely to refinance their loans, in which case the right to service that loan is going to decline in value because within a year or two, someone's going to refinance, in which case you might lose that loan. So there's this weird contra revenue line, and keep in mind, it's primarily an accounting thing. So when I'm valuing this, as you'll see, I completely remove the change in this mortgage servicing value, but it's a big headline number in which to value this company. So this is what I mean when it gets to the complexity of valuing this company, in that you're going to see this big headline, and there's a chance like one day that it's a big negative, and that's what you saw in 2020, like huge $1 billion plus, nearly $2 billion negative value from mortgage servicing rights. Well, it's like, well, wait a second, like you need to recognize that this is an accounting function and not necessarily a cash revenue function. So let's keep going. So we've covered the servicing fee income, we've serviced the gain on sale, and we've covered this mortgage servicing rights and the value that they, and keep in mind, they have to do it from accounting perspectives because that income is coming from an asset that's on their balance sheet. And so they need to account for that asset on the balance sheet and how it changes. And that's the reason why it flows through the income statement. So, you have these, let's go back. So you have the gain on sale, which we talk about the origination times whatever percentage gain, let's say 2.5% to 4%. You have servicing fee, which is very steady, incrementally builds each year over time. Change in fair value, which is primarily accounting. Let's say you can ignore that because it's not really a cash revenue aspect. Interest income, this interest income component is effectively you have the loans on your balance sheet, and before you officially sell it off, you collect whatever interest payment on those loans, and then when you sell it off, you're no longer collecting interest. So there is this sort of spread business. It's not huge. I wouldn't say it's not material, but it's not huge relative to the total business. And then other income, well, that's where they're like doing all these other initiatives. Like, hey, we want to make sure it's a seamless process. So like, what if we do the title insurance, and what if we do the valuation work, and what if we do all these other components, and we get into the Canadian home mortgage, and we get into the auto loan space. So like that's where this other income line, and the other income line has been growing very quickly. Now, one should note that this gain on sales is going to be wickedly volatile, very lumpy. And so people looking at 2020 figures are like, oh my gosh, this is up significantly from 727 million to 1.8 billion. This is fantastic. Well, like, wait a second, that's not recurring revenue. This is a one-time transaction, the way to think about it in that period. And what's actually driving that? So we'll get into this aspect in just a second, but that's the part that makes this business model very tricky, and I'd argue not a traditional valuation approach. You can see 3.3 billion gain on sale down to 2.9 as interest rates rose. People didn't want to refinance as often, and then 4.9 billion in 2019 as they started gaining market share from partnerships. So you can see these different components. So how do you value this? We've covered all these different elements, and I'd argue like, look, this is super not easy. There's a lot of components that you need to understand, and I haven't even covered all of it. There's a lot more. You need to understand that performance is going to be very volatile, which we'll talk about in a second, and that the org structure is very fun and going to be very confusing. And you're going to say, how come, Daniel, you're using figures that are very different from my Yahoo Finance or whatever? So you definitely need that thinking cap. Let's keep going. So here's why it's going to be super volatile, is because their market share, let's say, steadily increases, 5, 6, 7, 8, they had this big jump in 2020 to around 9%. Let's say they're able to keep it. Well, the dollar figure of home originations, and this is from their filings, is expected to decline fairly significantly over the next 2 years after we have this huge jump in 2020. A lot of people are moving from, the cities to the suburbs in response to COVID. And, there's also the interest rates took a dive in 2020, so you're able to refinance at cheaper rates. Those two things, if you're in a higher rate environment, or there's just let's say depressionary economics, why should this figure go up significantly in the future? Is it possible it just sort of stagnates, or maybe it gets back down to 1.7? You know, you had 1.7, 2.2, 3 billion, $3 trillion in home mortgage originations. What if it actually trends back closer to 2 trillion? In which case 2 trillion, that's, you know, you're losing, or 1.7 trillion even, in which case that's like a 50% potential decline, which would be very volatile. Now they'll offset that with market share gains, hypothetically, potentially, but that is an element that's worth considering, understanding about the long-term value of this business. It's going to be very lumpy, and when you see projections like this, you're less likely to get just crazy, you know, valuation multipliers. Whereas when you're looking at some of the, you know, potential multi-baggers that I call out, where it's like, hey, this company's growing over 100%, or I think there's a good chance they keep growing at 30-40% a year in the years ahead, you're more likely to get that prime valuation because people are pumped to own this fast grower. Whereas here, a story like this, people are like, well, wait a second, if interest rates start going higher, is there a real chance that the dollar amount of financing starts dropping significantly in the years ahead? I mean, this has had a major tailwind of lower interest rates. So it is a tricky element towards thinking about the gain on sale and how much new loans will be originated on behalf of Rocket Mortgages in the future. Here's another aspect to this that makes the story extra complicated, and that's going to confuse a lot of people, because when you look at the financials, especially the recent financials, you'll see an item right before the very bottom line, you know, net income, there's non-controlling interest. And this is, you know, so you have Dan Gilbert, he's here, he's the founder, he owns Rock Holdings, RHI. Rock Holdings owns Class D common stock. The Class D shares have no economic interest, so no economic value, has 79% of the voting power, but does own these non-voting units that represent 92% of the economic interest of the subsidiaries that do all this business. Confused? Let's keep going. So it'll make sense in a second, hopefully. So the public shareholders own A shares, which have a 20% voting interest. So either way, Dan Gilbert, which controls Rock Holdings, is going to be deciding what goes on with the company. So understand you're in a controlled vehicle. You're making a bet on what Dan Gilbert has to do. And, okay, you have 100% economic, close that up. You have 100% economic interest in Rocket Company, this issuer, but this segment, this business, only has an 8% economic interest in the core subsidiaries that are running the profits for this business, that generate the profits for this business. So that's a key aspect you need to understand. So these Class A common shares owns 100% of this, but this segment, Rocket Companies, only owns 8% of the economic value, the actual cash producing assets. So that's a very tricky aspect. So you as a shareholder effectively only own, if all the shareholders of Rocket's common shares, the Class A common shares, got together, your total economic impact, from my understanding, is 8% of the combined entity. So when you're looking at the market cap, you need to be looking at the Class A shares only, not the Class A and D shares, because the Class D shares don't have any economic interest. So you need to ignore those when you're thinking about the market cap. In Yahoo Finance will take the Class A and Class D, combine them, and use that to multiply for your share price. That's, in my mind, that's not the right way to do that. As always, if anyone wants to leave any comments, they're totally welcome to in the YouTube channel, just because this is pretty confusing as is. So when you're doing your valuation, you need to understand you're only getting 8% of the pie. So whatever figure you see before, you know, your pre-tax profits or your after-tax profits, that figure is going to be dramatically lower once you factor in that you are only getting 8% of the pie. The vast majority is still going to RHI, which is owned by Dan Gilbert, the founder. Next up, so let's dive into the financials or projecting how to value this within a few years out. So once again, this is going to look quite different than what you're going to see in Yahoo Finance because of this element where the Class A shares only have 8% economic interest in the entity, and so you should only be valuing this based on your Class A shares versus and excluding the Class D. That's what I'm effectively arguing here. So the Class A shares are 115 million shares. So you take that and you multiply it by the share count. That gets to the value of this segment that only has 8% economic interest as worth about 2.4 billion. That's dramatically different than what you're seeing in Yahoo Finance, which is like 40 billion plus. But that includes all the D shares, which is voting power and zero economic rights. So once again, I think this is the appropriate figure to think about. And look, once again, if someone has, contrary thoughts, feel free to articulate it below. So, and keep in mind, this is part of my value proposition to YouTube viewers, my loyal YouTube subscribers, where I create sheets like this for you to think about. You can play around with the assumptions. Do you think it could go higher or lower? That's up to you. I always think these things can go higher or lower than my valuation framework, but I like to work from a logical basis in which to judge and value these companies. So let's start off understanding that here it is, this segment, which only has 8% economic interest in these assets that do produce these immense value. So that segment is worth 2.4 billion. Now let's think about the underlying economic power. How much net income these segments, this origination, everything, the whole pie can generate. So first start off, and so this is a very different way of how I'm usually doing it. So I will do a detailed walkthrough of how I'm thinking about this. So instead of saying like, hey, what's your growth rate over the next few years, which is very hard to forecast for a business model like this. Instead, what I'm doing is let's think about 2025 earnings power. So let's look out 5 years and then think about what could be the multiple 5 years from now. And so let's first start with U.S. mortgage originations total. So I'm saying the total in 2025 could be $2 trillion to $3 trillion for the whole U.S. market. Now that effectively is pretty conservative, one could say, because this year alone we're at $3 trillion. But a lot of people know, like, wait a second, there's a lot of refinancing that's going on as rates dramatically drop, and we also have this, this COVID bump. So that's unlikely, so I'm trying to match some sort of conservatism with the fact that, if rates start going higher, home prices aren't less likely to keep appreciating, in which case the dollar amount of home mortgages, isn't likely to significantly increase. So there's some tricky aspects, but I'm trying to be conservative at the end of the day, from $2 trillion to $3 trillion in terms of the U.S. mortgage originations total. So then what's Rocket's share of the total? So the low assumes that they effectively don't capture that much over the next 5 years. They stay at 9%, they go up to 10%. The high side is they start going to what they hope to do. They've articulated 25% of the market, which would be incredible for them to hit. But they're saying, hey, maybe we can, I'm saying, hey, maybe you get to 15 in the next 5 years, which would be still very nice market share capture, going from 10 to 15%. That's 5% share. That's 50% growth in terms of market share capture. What's the gain on origination? This is, I'm thinking effectively, what's your long-term earnings power for this business? And so I'm saying I'm doing a range, 3% gain on origination, 3.5%. It depends on how competitive the space gets, how well they continue to do. Is it possible they've already gotten a lot of the low-hanging fruit? And so let's say delinquency rates start ticking up and they're just not able to get the same sort of, juicy gains that they've gotten in the past. So 3 to 3.5%. So that gets to gain on sale of loans from anywhere from $6 billion in revenue to $16 billion in revenue. So that's a huge, pretty sizable range, but it does reflect, pretty significant growth from where they are in 2020, at least on the high side. So then you have these other aspects like the servicing fee income, which I'm saying an annualized growth based on their sort of book of business continuing to grow. So, does this grow at 7% annualized over the next 5 years, or does it grow, 12% annualized? I'm putting a range. Could I be high or low on this? Absolutely. I use the same sort of growth range for their other income. In this case, this might be low, especially as they're looking to make some investments in this space. And then net interest income, which is pretty small, growing at the same sort of rate. Once again, I'll drop this sheet available for you to play around with, so that way, if you want to think one thing or the other, you're totally welcome to. So you get total revenue of around 10 billion to 20 billion by 2025. So then the next tricky part is then what's the operating expenses as a percentage of revenue? And so here it is, I'm saying historically it's ranged from about 80 to 85%. So I'm assuming you're able to get some leverage, up to 70% of their revenue is their expenses. And there are some give and takes here, because keep in mind their marketing ad dollars is a big component of this. So if they're able to truly build their brand, they may not have to put all that ad dollars into the business if they're growing, like with things with partnership and just people know, hey, this is the mortgage originator I want to go with. If they're getting their growth rates without having to spend big bucks in ad spend, or it's a tech platform, is it possible they continue to leverage it? Yes, there's a lot of hand holding and aspect with the servicing, which would create a lower margin aspect to it. But when you look at this, is it possible you start getting some operating leverage? And that's sort of what I'm penciling out here, is that you get a little more operating leverage over time. So effectively your profits go to 30% operating margins versus 20% here. And keep in mind the range over the last 5 years is effectively 15 to 20% ballpark. You could say it could be higher if you wanted to. So you take that, and then you take some sort of tax rate, and you're saying the the earnings for the total pie of Rocket is around 1.5 to, let's say, $4.7 billion. So a lot of earnings power that they could be generating each year. So then this is where you have to factor in this org chart where you only own 8% of it. So your economic interest is only around 8%. So that's 120 million or 374. So 8% of this net earnings. So your implied price to 2025 times, your price to 2025 earnings is somewhere between 6 times and 20 times, which is not, it's not crazy cheap. It's not crazy expensive. I would argue that this is probably fairly valued. The question, there's some components here of like, could they have higher margins longer term? But you need to start asking yourself, well, what do you think the multiple should be in the years ahead? And is it a chance in the high side that it would actually be valued at 18 times? In which case, if it was valued at 18 times in this scenario, then you'd have several 100% upside. Whereas if it's valued at 12 times, then you'd lose a lot. You'd lose closer to 40%. So this is the type of situation where I see, maybe you lose 40%, maybe you make up to 200%. That's my back of the envelope, how I'm thinking of this. And look, this is a super tricky setup. So if anyone is like, you know what, Daniel, I think you need to sharpen the pencil on this aspect, or relook at this aspect, I'm totally open to hearing what anyone else's contributions or thoughts on this. I'd love to hear it, just because I'm very impressed with what Dan Gilbert has built. I'm impressed with the customer satisfaction, but this is a very tricky business model. And so could this go higher or lower? Absolutely. It is interesting to see that it could potentially have up to 200% upside, just assuming arguably a reasonable 18 times multiple 5 years out. But so what are my summary thoughts? I like rocket companies. I'm impressed with Dan Gilbert, the founder. He's a pioneer disrupting the loan origination market. They seem like they deserve to win. They seem like they're doing everything right, like writing better loans, doing better marketing, getting better refinancing leads, getting better leads, working with the right partnerships, clearly tapping into a huge opportunity. If they can get 25% of a $3 trillion market, that would just be a huge win over time. Then the stock would definitely go higher. So, one could argue, Daniel, just pause everything, pause all this analysis, and it's a bet. Do you think Dan Gilbert and this team that they've built at Rocket, do you think that they could successfully take this company from 10% market share to 15 to 25? If you think that's the case, and you think that U.S. home mortgages will be $3 trillion and up over time, then it's probably worthwhile to own. That's sort of the thought process here, is that they will deliver satisfactory results, potentially. And I like the fact that they're likely this unrivaled value proposition. The fact that they consistently take market share, that is one of the best signals that I get in terms of being unrivaled. Do you have something that gives you the right to win? Are you unrivaled, where you take share from your competitors and seeing, oh yeah, we were at 4%, then 5%, then 7%, then 9%. That means you're doing something better. And in this case, I think it's a whole host of things. I think it's servicing the customer better. I think it's finding better customers, getting better refinancing, getting them before they potentially go with someone else. So I think they're doing so many different things right that they deserve to win. The challenge is, it seems fairly valued. It doesn't seem like it's screaming cheap, especially given the fact that you have this huge COVID bump in 2020, and there's so much complexity that I suspect a lot of people don't understand what they actually own, especially given the fact that they only own 8% of the economic interest in the key entities that generate the profit. So like this whole like $40 billion market cap versus how much is this entity, which is what you actually own, worth. And so this is, that it's tricky. Like it makes me, some of the companies that I've looked at that have done well, you have a narrative. It's clearly articulated. People can understand, oh, your revenue's growing 50%, 70%. Oh, you're unrivaled, and you're going to keep growing each year. Whereas here, it's going to be lumpy. Like their gain on originations, that line item might drop in half in the coming years. Now that doesn't really affect your long-term earnings power, but like, how excited are people going to be to buy the stock if you know that there's potentially a doldrum in terms of home mortgage originations for years in the future? So what's the right multiple when that happens? Maybe the right time to revisit this stock is after that happens and see how they're performing during that period. Well, let's say it's the exact opposite of today, where instead of them being an incredibly tight supply of homes, where there's just like plenty of homes, people generally, people just aren't buying them either because they don't have the income, or it's, they're not looking for it, and the amounts drop significantly. Like if you have a reversal of 2020 and the dollar amount of home mortgage origination drops to 1.5 trillion, so literally drops in half, I suspect this will be valued lower in that scenario, because people are like, how long will this last? And people will be bearish on that. So I think there's a cyclical aspect to this story that you probably want to revisit when that number's lower versus higher. Is it the right valuation? That's the, in their case, a $10-20 billion question. What's the right valuation to pay for arguably a cyclical business? I've called out 2 potential multi-baggers already this month. If you go to unrivaledinvesting.com, click on Journey. So that's for my Journey subscribers. This is exclusive content where you can see what I buy, what I sell, what I hold each month. So each month I get a download of my total portfolio, and then any big interim updates for my portfolio changes, what I've bought, in a big way, I'll give you an update. And each month I aim to identify at least one potential multi-bagger, the type of company where I'm like, yeah, I think the narrative is fairly clear. I think they have a very strong value proposition. I think they could go up several 100% over time. And so that's the goal with each month. Identify at least one potential multi-bagger. Also have an educational series, like how do you value stocks, or how do you think about hedging? Also commentary about the market. How do you think is this market super cheap or is it expensive, and what should you potentially consider? So there's a full catalog of content that I put in the description of this video, so that way you can click on it if you want to get your feet wet and just see what I'm posting. That's all the exclusive content there, and that's sort of how I organize it, where it's portfolio updates, monthly potential multi-baggers, then exclusive follow-up on some stocks, educational content, and stock market commentary. And at the end of the day, just finding one potential multi-bagger can change your life journey. So if you're interested in following my journey to try to find these potential multi-baggers, go to unrivaledinvesting.com. And if you enjoyed this video learning about rocket companies, will it be a rocket stock in the years ahead? I'm not sure. We'll see. But I'm definitely going to be very interested following this. But if you enjoyed this video, make a point of following, subscribing to this channel, Unrivaled Investing, and thank you so much for watching.